Welcome to the Independent Advisors podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessupwealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 252 of the Independent Advisors podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So welcome back to the show, Matt. It's been a little while.
Nice to be back. My toughest job this week was sifting through all the content I had and narrowing it down.
Yeah, there's no shortage of headlines and data to talk about. So I think we have some good things in the dock here today.
Yeah, before we begin, the PGA Championship, what's your thoughts this weekend?
Yeah, so they teed off this morning. I'm very high on Rory McIlroy right now. He won last week at the Wells Fargo Championship.
Yep.
And he's won at that golf course before, and his last major championship was the PGA Championship at Valhalla, which was a decade ago. They're playing at Valhalla again this week, so riding the hot hand of Rory McIlroy this week.
All right, we'll check in the coming weeks. I love it.
Yeah, Tiger's in the field, so we'll see how he does, see if he can make the cut. So, yeah, should be a good weekend.
It was interesting seeing John Daly out there on the range just doing his thing. It's hilarious to watch him.
He's the best.
He just does his own thing.
Yeah, I was actually listening to a golf podcast the other day, and they made a good point. Like, he gets all the headlines and media time for being this crazy golfer guy who, drinks 10 Diet Cokes during a round and smokes a pack of cigarettes or whatever.
Sure.
But if you think about it, back when he came onto the scene, 2 decades ago, he got a lot of non-golfers involved in the sport,
yes.
Right? So he drew a lot of people to the sport of golf, I think. So, he's a former PGA champion, so he's back in the field today. So he was riding around in a cart playing his practice round yesterday, I saw. So
good for him.
Hopefully the weather holds out. I know we're supposed to get thunderstorms here in the Midwest over the next couple days, so hopefully they get it in before Sunday.
Yeah.
As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on May 15th. S&P 500 index is up 5.4% for the month and up 11.3% for the year. The Dow Jones Industrial Average up 5.5% for the month and up 5.9% for the year. The NASDAQ Composite Index up 6.9% for the month and up 11.5% for the year. The Russell 2000 Small Cap Index up 6.9% for the month and up 4.3% for the year. And the Vanguard All World ex-United States ETF up 5.6% for the month and up 7.6% for the year. 3-month Treasury rate at 5.45%, the 2-year Treasury rate 4.73%, and the 10-year Treasury rate at 4.36%. So we've seen rates come in a little bit over the past couple of weeks as markets have kind of recovered from their little mini sell-off in April.
Yeah, and we were talking about it earlier in the year in the podcast. We thought, hey, is that correction going to come in February? Is it going to come in March? Is it going to come in April? It came, and we were talking about, people who are underallocated to equities, where they're going to kind of take their turn at bat. And just as a reminder, when you're in those periods, when the market is off 5-6% from its high water mark, and you see some of the talking heads in the financial news networks, and you think, okay, yeah, this could get into 10-15% correction, and boom, 2 weeks later, makes it almost all back.
Yeah, very, very short-lived. So,
yeah.
Moving on to big headlines and current events from the week. We got the latest inflation numbers recently, Matt, and inflation eased slightly in April. The CPI increased 0.3% from March, and that was below the estimate of 0.4% expected. Year over year, it came in at plus 3.4%. So I think this is the first time in 2024 that CPI came in below analyst estimates, which is great. So Jenna will throw this chart up on the YouTube page. It'll be in our show notes that just shows the trend of inflation since January of 2021. where you can see it kind of peaking in the middle of 22 and has come down significantly since then. So all good news on that front.
Yeah, I think I saw, this changes daily, but I saw on the CME Futures Exchange that the chances of a cut in September went up to like 75% after this data point.
Yeah, interesting.
Yeah,
so a lot of people thought that we would have a cut or two by now, but that still hasn't happened.
And we might not get one.
Which I think is okay too.
Yeah.
So next thing that I'm sure a lot of people have seen over the past week is the meme-related stocks are back in the headlines, having their wild swings and volatility.
Yep.
The two most talked about names are GameStop and AMC, which were both up several 100% at one point this week. So a little bit of background on this to jog people's memories. A few years ago, GameStop and AMC Entertainment kind of became the center of, this highly publicized phenomenon known as the meme stock craze. And this was driven primarily by retail investors on social media platforms like Reddit and Twitter. The Wall Street Bets, Roaring Kitty. It's kind of crazy to talk about again, that we're going through this again.
Just take a second and think about the insanity of what we are saying.
Yeah.
Someone who has labeled themselves Roaring Kitty puts a video up and people just
blindly buy the stock.
Blatantly just buy a stock.
Yeah. So, and again, just to give a little bit more context, back in January of 2021, GameStop's stock price, for example, went from about $20 a share to $483 a share within weeks. This surge was kind of fueled by this coordinated social media effort of retail investors to drive up the stock price, which created a short squeeze in institutional investors who were heavily short the stock. So again, if money managers are shorting a stock, they're expecting the stock to fall. They make money when the stock falls. But what that can do is if you get enough people or enough money buying that stock, it's going to force these institutional investors to what we call cover their position and buy back the stock. Because when you short a stock, you have unlimited downside. That stock can go from, like GameStop did, $20 to $483.
That's right.
And these people are down significant amounts of money, especially with leverage.
And where their accounts are held, if they don't have enough collateral, and as that stock moves against them, that institution's going to force them to buy it back.
Correct. So there are a lot of institutional investors that bet against stocks like GameStop, expecting that price to fall. But, when retail investors bought massive amounts of that stock, they forced the short sellers to cover their position by buying the stock back, which further drove up the price. So kind of seeing that again. I don't know how long it's going to last, but these names have been extremely volatile over the past week. So we'll just have to wait and see.
Words of wisdom. You are flirting with some pretty risky things here.
Proceed with caution. You're flirting with risky things on both sides of it, right?
Absolutely.
If you're jumping in to buy it, or if you're like, oh, this can't continue, I'm going to sell it or I'm going to short it. There's risk, a lot of risk on both sides of that trade right now, I think.
Words of wisdom. Just get a bag of popcorn and watch from the sidelines.
Right.
Words of wisdom.
Right. It is pretty entertaining.
Yeah.
Moving on to tweets, articles, and research from this week. First thing I had was an article from Ryan Dietrich on May 7th titled 6 Reasons This Bull Market is Alive and Well. And Jenna will throw this chart up on the YouTube page in our show notes. But what this shows, Matt, is the S&P 500 performance when the first quarter is up 10% or more, like it was in 2024. So to be a little more granular, 2024 Q1 was up 10.2%.
Yep.
And what this chart shows is all years that Q1 was higher than 10% for the S&P 500. It shows the April returns, Q2 returns, and the final 9 months of the year returns. So that's what I want to focus on here is on average, when Q1 is up greater than 10% for the S&P, The final 9 months of the year are positive 91% of the time with an average return of 6.5%.
Giddy up.
So again, small data set, but the only time the final 9 months of the year were negative was in 1987, obviously for obvious reasons in the fall.
Yes.
So just thought that was an interesting stat by Ryan. And the next chart that I pulled from this article by Ryan was the S&P 500 performance under new president. So this will also be viewable on YouTube here for everybody. So what this shows is that stocks have never been lower in an election year under a new president, or in other words, a first-term president. So when the first-term president is running for re-election in the election year, the average return has been 12.2%. And again, it's been higher 100% of the time. Again, dealing with about 10 instances here, so it's not a huge data set, but this does go back to 1950. So kind of as we've been preaching all year, we do feel like, with all the data that we have, 2024 does have the potential to be a pretty decent year again.
Yeah, I mean, it's telling you the seasonality.
Regardless of who the president is or who's running, right?
Well said. Well said.
Taking the politics out of it.
Yeah.
Second thing I had was a blog post from Ben Carlson titled "The New Normal and Housing Prices." This was back on May 3rd, and I touched a little bit about housing prices last week with Nick. But Ben says first-time home buyers would love to see pre-pandemic prices and mortgage rates again. We might get lower mortgage rates in the future, but I wouldn't hold your breath on prices. We're likely not going back. We've essentially pulled forward a decade's worth of growth into a few short years in the 2020s. Point Two Homes looked at the largest cities in the U.S. to determine how long it takes homes in those areas to double in price. Nearly 70 cities have seen their prices double in less than 10 years. It took less than 5 years for housing prices to double in Detroit, and it took just 6 years for them to double in Miami, Tampa, Baltimore, and Scottsdale. I'm not saying prices can't or won't fall. They can and probably will in certain areas. It's just impossible to see a complete retracement of prices back to the pre-pandemic days. Not only are prices higher, but replacement costs are higher. Wages in the construction industry are also higher. Plus, people don't simply sell their homes for fire sale prices just because. This is especially true when you consider nearly 40% of all homeowners have their house paid off free and clear. Yep. And the majority of people who do have mortgage debt have it at a favorable borrowing cost of less than 4%. First of all, that first stat surprised me. I would have thought that the people that own their home free and clear was in the 15 to 20% range, not 40%, right?
It's great.
But if you think of people who are homeowners, usually skews to higher aged individuals.
Correct.
Right? So this is an interesting chart that Jenna will throw up right now. It's the effective mortgage rate among outstanding mortgages by state. So it's the state of the U.S.
Yep.
And instead of the state names, it has the effective mortgage rate. So in Ohio, the effective mortgage rate is 4.2%. Some other key states, Texas, 4.2%, New York, 4.2%, California, 3.7%. So you can see that people that do have mortgages right now, for the most part, or the majority, locked in those lower rates several years ago.
Yeah.
Right? So he says the good news is for homeowners is that your house is worth a lot more now than it was when you bought it. Bad news for home buyers is that your house is going to cost a lot more than it did just a few short years ago.
Yeah, I think these are all great points. I think the one thing that was not mentioned here, which I feel is going to continue to be a factor in housing prices, is the erosion of purchasing power with inflation. I think if you look at the last 4 years, you've had the American dollar with inflation, you lost 20+% of its value. And I think that has had a correlation in real estate prices. And, let's just face it, the government continues to print money at the pace it's printing. You're going to continue to see upward pressure on these real estate prices.
Right. And I was actually just listening to Michael and Ben's podcast this week for this morning, and I didn't even hear about this, but they said that Biden proposed new home buyers or first-time home buyers to get government stimulus of $400 per month for 2 years after they buy a home, which I think is pretty obvious that it's just going to make this problem even worse in terms of increasing home prices, right? I mean, we saw this happen in 2020 when there was all this free money that was getting handed out that just exacerbated the problem. So, I don't know if that's the solution, but that's at least what the proposal has been recently.
I will do the best I can to say this very friendly. His proposed tax plan for next year is absolute insanity.
Yeah, it's not favorable. It's not favorable.
It would decimate the economy.
So, and again, this stuff is just proposals. There's a process to go to get this stuff approved. So, it's obviously gonna face a lot.
Most
of
likely,
pushback.
just for the shock and awe of the headlines. I'm assuming. I hope.
Right.
Yeah.
Last thing I had was kind of a funny one from TrendSpider on Twitter on April 24th.
This is hilarious.
Yeah, if you're looking at this, it's a picture of the tweet, and he says, "You gotta love it." And he says, "Tesla double miss on earnings, up 12% after hours."
Double miss means they missed on the top line revenue and the bottom line net earnings.
Correct. Meta double beat, so they beat on revenue and earnings, and they were down 12% after earnings, right? So I just thought that this was interesting because of it. If you're going to be investing in the markets, you need to get comfortable with some things not making sense to you.
Well
because
said.
On the outset of it, it's like if Tesla missed earnings, they should be
Stock should be down.
Right? But if you look the 3 months leading up to their earnings, the stock got crushed.
That's right.
And vice versa with Meta, 3 months or really the past year and a half, Meta's been on a tear, right? Mm-hmm. So the stock is baking all this good news in, and then it's down 12% after hours. And I didn't get too deep into the Meta earnings report, but it could be that forward guidance isn't as good as it was supposed to be expected, right? They're not growing. They're not going to be growing as much as expected over the next couple of years. So.
But you're making a very key point. There's going to be times where it just doesn't make logical sense at a first glance.
Correct. And that's why I love the atom that even if you had the news for the next 6 months, it'd still be very difficult to predict where stocks are going to go, right?
Well said.
So.
Well said. Well, I got 3 really good pieces, okay? First one's going to be some stats about where we stand with this bull market so far. The reason I selected this, Mark, is you are starting to hear whispers in the market of, oh my gosh, the market's up so much off the lows of Q4 of 2022. How much farther can it go, right? So Ryan Dietrich put this chart together, and I thought it was phenomenal. And he looked at all bull markets going back to 1950. So to take a step back for our new listeners and viewers, the definition of a bull market is one in which there is no correction that is more than 20%. Okay. So that would be an uptrend. You could have a drawdown of 19.99%. And if it goes up from there, that is still defined as a bull market.
And the beginning of a bull market is defined as being up 20% from any market low.
Thank you, sir. Thank you.
So, and again, this is kind of what the industry has always gone by. I don't necessarily, and I know you don't feel that this way either, but it's not the best definition in my opinion.
I agree.
But you got to define it somehow.
You got to do it somehow, right?
Right.
So going back to 1950, Jenna will have this chart in our show notes on all of our social media sites, and it will also be put up here on our YouTube video. What you're going to notice very quickly here is the column of months. What is the average length? And depending upon how you slice and dice the math, it's somewhere between 50 to 60 months, okay, is the average length of an uptrend. And so far, we're at 19 months. So when you look at history and you look at averages, I think you could very well make an argument that the bull market is still in the beginning phase. Last point, most important. Just because we're in a bull market doesn't mean we're not going to get sell-offs and corrections. And sell-offs and corrections frequently. April's a good example. 6%. Why did it feel worse, Mark? Because we were in an uptrend for 5 months before it.
Right.
And so as an equity investor, just expect the rest of this year, we'll probably have, let's just call it 2 good corrections between now and the end of the year, looking at history, looking at the stats. But then you take a step back, even with all those sell-offs since the market bottom, the S&P's up 43%.
Yeah.
There's no free lunch. Corrections are going to happen. But when you take a big picture view of the bull market and with history, we're still young.
Yeah, for sure. And it's just part of investing, right? If you take a look at history and look at all of the, the best institutional money managers or hedge fund managers that have the best long-term returns, all of them have extremely high drawdowns too. I'm talking 50, 60, 70% from the high, right?
Yes.
So it's just something as investors that we have to deal with, right?
Yep. It's a byproduct of the longer term rates of return. So my next piece is a topic I think investors should continue to keep an eye on. Okay. So I want to point out something that I think is worrisome for a lot of professional money managers, which is the following stat. This is from Bespoke Investment Group, and our regular listeners and viewers know they produce a lot of good raw research data points. This one, Mark, has to do with the inversion of the yield curve and what that means in history of recessions. And I'm going to have you explain this here in a second. And to be more specific, the 10-year Treasury yield versus the 3-month Treasury yield. So let's have a teachable moment here. Will you share with listeners and viewers, what does it mean when they hear in the news that it's an inverted yield curve?
Yeah, so typically when you're looking at U.S. Government Treasury rates, right, you would expect that if you're holding U.S. government debt that is due in 20 years, that you are going to get paid a higher rate than if you hold U.S. government debt that's due in 3 months, right?
Right.
Why? Because there's a lot more that can go wrong within a 20-year period, theoretically, than a 3-month period.
And
it's
you
a
would
lot
be paid
less
a premium
predictable
to lock your money up.
Correct. So that's a normal yield curve, right? So an inverted yield curve is when shorter term rates are paying more than longer term government debt, right? So
Not normal.
Not normal. So a lot of people use the 10-year and the 3-month, or the 10-year and the 2-year. Regardless, most of these curves are still inverted. So shorter term government debt is paying a higher rate.
Well said.
Right? So that's what we're talking about when we talk about an inverted yield curve.
Great explanation. So to take this further for our listeners and viewers, why am I highlighting this? Why did Bespoke come up with this piece? It's because when you look at history, the inversion of the yield curve has historically been a pretty accurate predictor of a recession. So Jenna will put up this chart for our YouTube viewers. This will be in our show notes. Highly recommend this one. And what you're going to notice very quickly is it's been 561 days since the 10-year and the 3-month yield curve first inverted. Here's the stat. On average, Mark, recessions have started 589 days after the yield curve first inverts. And Bespoke put, we're not even at the average yet. And so when you look at this chart, there's a couple periods like 2006 where it stayed inverted for 712 days. 1998, it stayed inverted for 932 days. And heck, back in 1966, it stayed inverted for close to 1,500 days. Can this sucker stay inverted? You better believe it. And does it necessarily mean that once we hit that average of 589, we're going to have a recession? It doesn't. It's just that historically, this tends to be a pretty accurate indicator. And a lot of the raw economic data is still telling me we're having pretty good GDP growth. And the definition of a recession, well, the old school definition of a recession is 2 consecutive quarters of negative GDP growth. Don't get me on that soapbox.
Yeah. And I think that's the thing about this is that, some people are arguing that we already had a recession and that we already got it passed. Some people are arguing that we haven't seen it yet, and that's still to come. I know me and you aren't here to argue that point. What matters to me on this topic is when the yield curve uninverts.
There it is.
Because the past 2 times the yield curve has normalized, typically stocks struggle shortly thereafter for a little bit.
Yes.
So that's something that I'm going to be watching is, ears are going to be perked up definitely when the yield curve normalizes, because history has shown us that stocks can struggle a little bit after that.
Well said. My last piece has to do with the old adage of sell in May and go away.
It's one of CNBC's favorite headlines.
Oh, that gets me fired up. So there's a piece by Charlie Bolello on May 14th, okay? And this is what Charlie said. We're in May, and you know what it means. The return of the slogan, sell in May and go away. Very catchy indeed, but there's one problem. The data doesn't support it. While lower than the November through April 6-month period, the S&P's total return from May to October is still positive at plus 6.4% annualized on average, just during that period. Not exactly something you would want to, quote, go away from. So what you're going to see next is Jenna will put up this chart for our YouTube viewers. This will definitely be in our show notes. And what it does, Mark, is it shows the S&P 500's total returns from 1928 to 2023. And what it does is it dissects May to October, November to April. And so the old adage, sell in May and go away makes you feel, well, if a lot of people are doing that, the market must be down all the time during that period. Mm-hmm. Charlie highlights that that's not necessarily the case. And then to add to that, the chances of being positive in May through October is you got a 71.9% chance.
Right. Yeah, and it's no secret that November through April is the strongest 6-month period out of any point during the year, right?
Sure.
And we've talked about that before. I think where people lose sight is they just see the, sell in May and go away headlines and automatically think, well, May through October on average has to be negative, right?
Yep.
That's why they're saying that. And that's not the case. It's just, this 6-month period isn't as strong as November through April. So blindly following this, I don't think is a great idea. We've had some months in May, June, July that have been awesome, right?
Correct.
And if you just blindly, follow this advice and, go to all cash, for example, or fixed income during that period, you could be missing out. And, we've highlighted several times over the past couple of years of the detriment it does to your portfolio growth if you miss some of the best days during the year, or some of the best weeks during the year. And
good point.
Those very well could come during this 6-month period.
Very well could, Mark. Well said. So if you're okay with it, Mark, I'm going to transition to the financial planning topic of the week. I found a really good piece in Charlie Bolello's weekly update that I wanted to share with our listeners and viewers. You good with that? Mm-hmm. So this is going to be an update on Social Security, and I think this is going to be a really good highlight to focus on this week, okay? So, a lot of people are concerned about what's going to happen to Social Security over the next decade. How well is it funded now? I'm going to tackle a couple of these topics over the next 3 minutes. So first, what Charlie said is, quote, more people are receiving Social Security benefits than are paying in. And if nothing is done, the trust fund will run dry in 2035, at which point benefits will have to be cut. Jenna will put up the initial chart, which shows the annual cost of Social Security benefits compared to the program's income. You can clearly see here, Mark, the benefits outstripping the income. And if you think about it, demographics make sense. You got a lot of baby boomers retiring. You got a lot of people tapping the Social Security system, and you don't have as many workers paying into it.
And you have people, since COVID, you have people retiring earlier.
That's right.
And you can see this spike in this chart right after 2020.
There it is. And so the next chart Jenna's going to put up is the Social Security Trust Fund balance. So if you're curious, hey, how much is in that trust fund right now? This chart is indicating around 2.7 trillion. And that's going to be at a goose egg in 2035. Okay? So this is the most important point, is what Charlie put next. What are some of the things that can be done to change this, to extend the life of Social Security? So let's go through them. Raising the payroll tax, currently 6.2% each for the employer, and the employee is paid into Social Security. The 6.2%, that could be raised, Mark. Next, lift the cap on earnings subject to the tax. Here in 2024, Mark, that's the first roughly 168,000.
So anything over that is not taxed.
At that 6.2, an employer
right.
or employee. Next is, and they've done this before, increasing the FRA, your full retirement age. Currently, 67. So that would mean you wouldn't get your full benefit till 67 and a half or 68.
That would be very unpopular.
It'll kick the can. I think that that's likely, in my opinion. Reducing the benefits of higher income earners. Ooh, another thing I think is likely. They'll do some sort of needs benefit formula, kind of how they do with your Medicare premiums.
Right.
You make so much money in a given year, your premiums go up. You make so much money of taxable income in your AGI, you don't get as much SSI the next year. Something like that. Next, slowing the growth rate in benefits, i.e. lower COLA, cost of living adjustment. It's possible.
Yeah, very.
And then cutting spending elsewhere and diverting the money to Social Security. And Charlie put my preferred option, right? I think if there's one thing we come to an agreement on, it's that there's not a lot of camaraderie right now in Congress.
No.
So I'll be curious to see how they end up tackling this. You know, they can only kick the can so far. 2035 is going to be around the corner.
Yeah, and it's no secret that this would be political suicide if, you know, a candidate proposed getting rid of Social Security or significantly cutting benefits.
Yeah.
So I don't think
it's likely.
But obviously something needs to be done. I mean,
Yeah.
I think, you know, knowing Congress as we do, I'm sure they're going to wait to the last waking hour.
Oh, yeah.
Before getting something done. But I think eventually over the next 10 years, they will.
If it's the way they approve budgets, it'll be exactly
they
what you
will
said.
enact changes. And as we've seen over time, I think the easiest answer is raising taxes. I mean, taxes are higher now than they were 50 years ago. So, as time goes on, I would expect tax rates to continue to increase. So however that looks, I think that's probably what's going to end up happening. But I don't think the media-induced fear of Social Security benefits going away anytime soon it's really not a worry or concern of mine, because they're going to do something to fix it. It's just a matter of how.
Yeah, I mean, if we are forward-looking on kind of these presidential election cycles, you're going to have the election in 2028. It'll be that election, in my opinion, in 2032, where that is like the hot topic.
Yeah.
If I had to guess.
For sure.
Right? So that's what I wanted to end with. I want to throw it out there. If you want to create your own podcast, don't forget to use the promo code Jessupwealth to get your first month of Blueberry podcasting hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. And again, you can receive your first month for free with the promo code Jessupwealth. That's all lower cases, no spaces. Mark, final thoughts?
No, I don't think I have anything. It's been a pretty good couple of weeks here coming into the new month of May, which we're already halfway through right now. So things typically in terms of data and events for the market slow down during the summer months. So as we get into June and July, I think, typically we see volatility come in a little bit. But volatility has been pretty low all year, so it wouldn't surprise me if we got a few spikes here and there. But a lot of people go on vacations.
Trading volumes tend to go down.
So usually somewhat calm over the next couple of months. So I think we could expect that again. But other than that, nothing else on my list.
I can tell Louis is excited about the start to May here. He was very vocal at the beginning of the podcast. For those that watch the podcast on YouTube, he was definitely in the frame multiple times. But I second that. I like going into this late spring time period. tends to be lower news flow, more normal activity, and we don't have earnings season again until the end of July.
Yeah, which is nice. So,
Yep.
Well, thanks everyone for listening to episode number 252 of the Independent Advisors podcast. We will be back with you next week for episode 253.
Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessupwealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.